Hello, welcome back to the Insect Podcast. Zoya, podcast producer here. This week we're joined by ChAI. It may sound like the tea, but it is a company blending financial market expertise and advanced AI to price protection for raw materials. Joining Robin is Tristan Fletcher, co-founder and CEO of ChAI. Drawing on his background in hedge funds and speculative trading, Tristan and his team have taken tools once reserved for financial insiders, think satellite data, global shipping trends, and predictive modelling, and made them available to manufacturers. In this episode, you'll hear how ChAI has launched an insurance product that protects companies against raw material price spikes. And for our keen audience, listen out for the concept of Eigenzeit. It might change your view of insurance. Now let's dive into the conversation.
Welcome to this week's Instech podcast. Our guest this week is Tristan Fletcher. He's the co-founder and CEO of ChAI. Tristan, thanks for joining me.
Hello, Robin. Thanks for having me. Great to be here.
You run a very interesting business, which I look forward to hearing more about. Let's kick straight off with you telling us what ChAI does.
Yes, of course. So we came out of the financial services world with the ambition of democratizing access to the capabilities we had as speculators in banks and hedge funds, taking bets on commodity prices for our investors using really esoteric data sets like satellite pictures and tracking global boat movements with state-of-the-art AI on top to try and get an edge in that betting, and thought, let's take that capability and bring it to people actually making products in the real world to help them manage those raw material costs. And along that journey, realized that we needed something that didn't just forecast prices, but help people act on those forecasts. And that's where we are today. We've now got a product that protects people against price movements using that AI technology.
So before ChAI, were you a speculator?
I was. And I learned an awful lot about speculation. In fact, one fact that I find fascinating is that if you bear in mind that futures markets were set up to help farmers grow products to guarantee the prices they were going to be able to sell their stuff into the market and then manage their finances accordingly. And all these products are there to help the companies that we're working with at ChAI. It's astounding to know that only 3% of the traded volume in futures markets is by people mitigating risk. The other 97% is speculation. So I was one of that 97%.
So when you say democratization, effectively what you're saying is instead of this being a speculator's product so that lots of hedge funds and bankers can play amongst each other, you're creating a product that can be used by people who actually need it to protect against risk. Is that right?
Exactly. In fact, that is a legal requirement. So it's been non-trivial getting this out as an insurance product. And one of the challenges has been persuading regulators and the people who've given us risk capacity, etc., that people are going to not use this for speculation. And to do that, amongst other things, we need to be able to demonstrate the person has a physical risk that they are trying to get rid of, maybe a supplier contract or some note of inventory that they're trying to sell.
Now we're getting down in the regulatory weeds. We'll put people off if we talk about regulation too quickly. I'm more intrigued to know, you can't do this effectively unless you are backing your ability to successfully predict the future price of raw materials and commodities. Tell us a little bit about how you do that.
Yes. So, as I mentioned before, we have this strong capability, which is taking these esoteric data sets that we know have a relationship with the price of the material we're forecasting and underwriting. And we know how to take a satellite picture above a wheat field or track a boat carrying some iron ore between ports and turn that information into not just a price signal, an idea of what the price is going to do, let's say in 6 months or 1 year's time, but actually a whole set of price scenarios using mathematical terminology, a distribution of outcomes. And it's that distribution we fold into what the premium might be, protecting against the price movement in a particular direction. That's our core capability that's being brought to bear here.
What does the insurance product look like? So we've established we need to have an insurable interest, but just describe a little bit about the insurance product that you provide to your customers' ears.
Yeah. So on the whole, protecting against price increases. Someone comes to us, they say, I've got a problem if the price of this raw material that I make my product out of goes above, let's say, $100 a ton, $110 a ton if it's currently $100 a ton. How much will it cost me to get protection against that rising? So, okay, it's going to cost you $2 a ton. And they go, great. We give us that as a premium. And in the future, when the price is checked against our books, and we go, okay, we owe you some money. We pay that customer the difference between where it ends up being and 110 if it was above 110. It's bounded risk. It's because it's an insurance product, and we have limits and some of that other terminology you'll all be au fait with. And that means that there's an upper bound to how high the price can be. If, for example, the limit was that such that which said if it goes above $150 a ton, we have to cap it there. So it's always only bounded risk, but that makes it much cheaper for our customers as a result.
Interesting. And then sophisticated listeners are going to look at that and they're going to say, this has been in and around the Lloyd's market for a while. It smells of financial guarantee. The regulators don't like anything that looks like a derivative in sheep's clothing. You're clearly past all that. Has that been a hurdle along the way, and how do you get through it?
It's been a huge hurdle along the way. I think that the way we've got through it is pointing at other examples of products that also look like financial products that the regulators have been happy with eventually. And actually, I feel like often people don't say what they really mean. And the problem isn't so much that it looks like a financial product. It's actually that people are worried about the market risk embedded in the product. And when you find out what's really at the root of the concerns, and those concerns are shared by would-be capacity providers, we're able to address them. And what's interesting about our product is several things. One is the first contract we've written is actually protecting against prices going down, not up. So if you imagine an ideal situation, for every contract on a particular material we protect against an upwards movement, we have an equal amount on the downwards movement. There's no market risk. The other point is that we're underwriting a whole cross-section of different raw materials. Our sweet spot is probably fast-moving consumer goods, things like biscuits. You underwrite the price of a biscuit, you've got the cocoa, wheat, sugar. You've also got the plastic, wraps the biscuit, and then the cardboard that might take lots of those biscuits to the shop. And they're all quite uncorrelated with each other. So again, you don't really have some strong market risk like you might do in a hardcore financial product. And it's much more diversified than that. And it was really pointing that out a lot and working out how to point that out in the best way that it's won over the people we needed to win over.
So you mentioned there your first transaction. Well done for that. What can you tell us about that? Thinking, what was the raw materials and what was the profile of the buyer?
There's a couple of things that made us very happy about our first deal. One is that it's an existing customer who's been with us for a long time, very supportive of what we do. The other is that we've always made some claims about the circular economy, which maybe we'll go into later. And this customer is a very prominent recycling company, publicly limited one in Europe, protecting against the price of a raw material they're selling back into the market from recycling it. So in lots of ways, it's perfect for us.
That sounds like there might be a sort of green ESG type angle there, because you're encouraging people to sell recycled materials back into the market. Have I just made that up?
No, there definitely is. There's a few strong ESG consequences to what we do. One is that people are much more likely to use the raw material if they can hedge out the price risk associated with it. We've seen that in actually people using aluminium over steel in can making, because the London Metal Exchange brought out an aluminium contract that could hedge out the risk, and there wasn't a steel one. So if we bring out the capability to hedge out price risk and lots of recycled materials, people are going to be more happy to adopt them. The other point is that a lot of companies hedge out price risk by just buying loads of stuff and sticking it in a warehouse, which is a waste of space. It's also a waste of raw material. The stuff goes off, and it's bad for the environment. And if you've got a more financialized, insurance-focused way of offsetting that risk, you literally need less of the raw material. You waste less of the raw material.
Financialized. I'm not sure about that. I'll come back to you when I've had a check. So I've got the product and I've got how it's used. Are you providing that as an MGA or as a full stack insurer? What's your sort of status from that point of view?
At the moment, as an MGA, we have every ambition to be a full stack insurer with time. We're effectively using other people's balance sheet, and we'd love to have our own balance sheet.
What does the structure look like? You're the MGA. You must have in place relationships with carriers, reinsurers. You probably can't name names, but tell me a little bit about how all that comes together.
A lot of this rests on the reinsurance panels that we've got. We've got one very well-known, prestigious, A-rated US reinsurer that we have a good relationship with was behind this first deal we've executed. And we've got a relationship with them such that there'll be a lot more deals coming soon working with them. We also have another panel, which is more European-based, that depending on how events unfold and which deals we want to put into which kind of portfolio, we may use as well. So it's kind of starting with the reinsurers, and we had a particular arrangement in terms of a counterparty in the front for the first deal, and we're now exploring an awful lot of fronts and insurers to sit on top of the reinsurers in parallel. Now we've got the kind of credibility of the reinsurance behind us.
So you ended up getting your support from an insurance point of view from the US rather than the UK. Is that because there's some difference in the approach to risk? Were they just more welcoming of the whole idea than you were able to get in your homeland?
It's almost a cliche now to say that Americans are just better at capitalism, are better at taking risks, and just have a different attitude to building companies. The other sort of side of me that's this kind of VC-backed startup is keenly aware of the fact that raising money is harder in the UK than it is in the US. But it's still much easier than it is in most other countries, which is what I keep reminding myself and other people in mind. And no one owes anyone money. And it's the same. No one owes anyone a large amount of balance sheet for a new insurance product. But it was astounding. After years of talking to people in the UK and Europe, immediately, it was almost like the first people we spoke to in the States were like, yeah, this is a great idea. It makes money. It's uncorrelated to other risks we have. Why wouldn't we do it? I was like, yeah, that's the point we've been making for ages. So sorry if that sounds a bit negative towards a lot of people over here, but that's the reality. And they'll make lots of money as a result.
It's a trend that we're seeing more and more of. And I'm a patriot through and through, but I can't ignore the reality that I see on an increasingly daily basis. Are you optimistic now? You've done a risk, you can prove the model, you've waited a long time for this moment. Have you got lots of stuff in the hopper that was waiting for you to get that first one out of the way and you can now start doing this stuff in earnest?
Yes, a lot of companies didn't want to be the first to do a deal. Understandably. If I get the impression that some companies literally have a policy somehow, I don't know how they'd word it, of not being the first to buy certain products. And now we've overcome that initial obstacle. There's an awful lot of people who are suddenly like, okay, this is for real, right? All those sales calls we had, they've meant something, and we're happy to progress at a much more accelerated rate. And there's some very big brand names that we're very excited about, who we're hoping we'll be able to mention when the time comes as well, just around the corner. And they're all in raw materials that they're just unable to hedge out price risk with in any other means at the moment.
And are there any macroeconomic themes? In other words, do people do this more often in certain economic circumstances and then less often in more benign conditions as a theme there?
They certainly do. Even before insurance, we would always get interest in a commodity when there'd been a particular amount of volatility in it. We had a lot of interest in cocoa. If you remember, there was a huge run-up in prices around Valentine's Day, amusingly, and everyone was coming to us about cocoa. We had something similar in coffee. Right now, we're getting a lot of interest in copper, etc., on the forecasting side. And clearly, there's an awful lot of uncertainty being generated by the current US administration that is reflected in our inbound interest. We had a flurry of people getting in touch with us from Canada not that long ago when the tariffs were announced against Canada's rescinded, etc. I guess the uncertainty is what we're here to mitigate, and it's being generated with an amount of enthusiasm I don't think any of us have seen in a long time, unfortunately.
I don't think long term here I am being an economic pundit, Trump's tariff is good for anyone. But is it fair to say it's good for you?
It's good for us as a business, yes. I have to say, in times like this, brokers, people trading, anyone who thrives off volatility does well. And it's good from that perspective. But as a human being who happens to be running the business, I'm not very impressed.
Join the club. So you're at a really interesting moment in your development. You've worked hard for this, and you're on an Instech podcast. Anything that the Instech community can help you with? There'll be a lot of listeners. Any particular sort of segment of the community who you'd like to hear from?
Yes, I've given your listeners requests for help before, perhaps on stage, and it's changed now because before we were looking for reinsurance capacity. Like, we've got this very prestigious reinsurance capacity, good relationships, etc. And now it's actually getting it in front of customers. So it's working back from the customers, brokers, people who are dealing with the end user, and fronts and insurers to sit on top of this reinsurance capacity. It's anyone who's interested in de-risking all the uncertainty that's being generated right now. I'd love to hear from them, please.
You've been very diplomatic, but it's been a long journey. We've shared some of it together, both in terms of regulation and in terms of proving the demand for the model. Is there any part of you that wished you'd stayed speculating risk and you hadn't even bothered to set this business up?
Yeah, loads of me. It's like you make a Faustian pact at some point without really knowing it's a Faustian pact because you don't know how painful and how long it's going to last. And I feel a bit like I assumed there was this contract with the universe when I was younger, and I put in effort and I got results because I was lucky and there was a relationship between effort and results. But a successful company, effort is necessary, but it's not sufficient. And the last 6 years have been, brutal with all the effort we've all put in at ChAI, co-founders, employees, etc., and even our investors occasionally. And it's taken more out of us, I think, than we thought it would. And it's just out of bloody mindedness that collectively we've got this across. To say where I think it's worth it, quite frankly, I'm not sure yet. Ask me when we've got lots of customers over the line and we feel like we're really helping the world de-risk things instead of having the ambition to help the world to de-risk.
I feel for you a bit because you've had all the hard yards and you haven't yet had the benefit. And I can feel lying ahead, if you really have made the world a better place rather than just speculating, you'll sit back with some pleasure. So I don't want to put all these entrepreneurs waiting off. If you've got a bit of insight for anybody who's thinking of setting up a business, what would it be?
Of course, I think the kind of people who set up businesses are a bit like you and me. They want to get stuff done. They want to change the world. They're impatient and they're used to having some agency. They do something happens. And when I learned building insurance in particular, and this is different to other domains I've worked in, is that things will take their own sweet time. There's a concept that exists in physics called Eigenzeit, which is one of those lovely German compound words, which is like process time or something having its own time you can do nothing about, you cannot influence. And I feel like more so with the insurance product than anything else at ChAI, it's taken its own time. And we had to put all the effort we needed to put in because we wouldn't be where we are today. But we couldn't speed it up at any point. It was just going to keep going. And I think coming to terms of that is hard. And it's particularly hard for the kind of people who want to be entrepreneurs. You've got to simultaneously believe that you can influence things, that you have a reality distortion field to make the world a slightly different place, and also accept that the world will ignore you a lot of the time and just keep on going, spinning around. That's hard, very hard. And I refuse to change, so I'm just constantly banging my head against the world and wishing that things would speed up a bit.
I love that. It's a really nice piece of analysis. It's something we've all experienced, but I never knew there was a word for it, and that's going to enter my vocabulary on a regular basis. And I think you might even have found the title of this podcast for us. We always do this at the end. We always ask people if they've got one final message from the audience. We're going to take Eigenzeit away with us. But any last messages you'd like to share with us?
I suppose going back to the insurance thing. So insurance was not my natural environment. I'd worked in other aspects of financial services. I've worked in academia. And I've always thought insurance is impressive because it's the thing that built financial services. We have asset management because of insurance. We have our financial markets because of insurance in the UK, and that's what made us punch above our weight for so long. And then I start working in insurance, and I'm seeing the world around us, and there's so much uncertainty. And guys, we got to step up and match that uncertainty with insurance, which is what, as a theme, was built to help organisations, people, etc., with all the uncertainty being generated. This is the time for the industry to shine.
Look, Tristan, it's been a pleasure to have you. Well done on that first risk. I sense that we're talking to you at a moment where you've worked hard, you now have some validation. I hope that this drip turns it into a torrent and you'll come back and you'll tell us all about it and the vast amounts of money that you've made for yourselves and your backers as a result of all the hard work you've put in. Good luck with everything, and thanks for joining me.
Thank you very much. Thanks, Robin. I've really enjoyed it.
Well, if you've made it this far, then I'm pretty sure you found that as interesting as I did. The Instech podcast comes out every Sunday morning, where we spotlight the latest news, leading voices, and freshest updates across insurance that you need to know about. If you would like to take part in these conversations, head to www.instech.co to find out how you can join our network and be a part of the insurance intelligence for the curious.